What's going on, guys? Welcome back to another video. Now, I know a lot of you guys watching this here are ready for some life-changing money. Now, we covered this in the private stream earlier today, and we also talked briefly about it in the public stream today as well. And I want to go through this trade that I've been talking about for a while that I finally got the first green light on in terms of the dominoes starting to fall here. Now, the confirmation of this was really what was said in two key parts of yesterday's Fed meeting in the statements from Powell. We're going to walk you through, guys, the entire thesis, what has happened in the past, what the potential of this play is, and how you guys can fully capitalize it on it, and the things to actually look out for when this trade is actually about to fire off. So, guys, if you are ready, and before we get into all of that information, if you wouldn't mind hitting that like button down below, it actually lights up now, which is pretty cool. And again, subscribe if you do want to see more videos like this. But let's get right into it here and take a look at the first part of the Fed meeting that we need to kind of hone in on. So if we blow this up right here a little bit. So this is a question that was asked of Powell. Hi, Howard from Reuters. I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not, meaning the pace of rates. So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will eventually be how long to remain at a restrictive level. So on the first question on how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so, moving 3.75% since March, admittedly from a base of 0. It's historically fast paced, and that's certainly appropriate given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we are saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question we think now is how far to go. And I'll talk more about that. Now, what Powell has essentially said here is they are going from putting more weight on how fast to tighten policy, but more so looking towards how high that they are actually going to raise interest rates. Now, the key extrapolation here, and to make this super simple, is that the Fed doesn't know how high they need to bring interest rates in order to get things under control. If you read through this entire statement here in this question and answer section, well, there's a lot of context and in conversation on lag. A lot of the data points that we're looking at in terms of job openings, any other unemployment reports, inflation data, everything is lagging. So what the Fed is doing or has done 3 months ago is starting to have some effects today, but they don't necessarily know, well, if we continue to raise rates now, how is that going to affect things 4 months down the road? So the question now is how high do we raise rates? And they do not know that. So Powell, there is a very, very high probability that they raise rates too much. We've been talking about this concept a lot, that the risk isn't necessarily that they raise rates too much. It's that they don't raise rates enough in order to get these inflationary pressures out of our markets and out of our economy. So we move on to this next section right here. And the question is, if I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much, which is exactly what we've been talking about a lot. Is that what you're trying to tell us today? And is that risk that risk assessment has changed a little bit? And here was Powell's response. Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over tighten, and we don't want to, we want to get this exactly right. But if we tighten, then we have the ability with our tools, which are powerful to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens and if that's necessary. Now let's break this down right here. Powell is saying that if they end up over tightening, which is very likely, especially from the statement that is made at the very bottom here, let's see if it's actually here, that means we have to have policy be more restrictive, and that narrows the path to a soft landing. So as you start to raise interest rates, the path to a soft landing gets even narrower, meaning a lot more unlikely. But what he's essentially saying in that statement is that if they over tighten, which is getting more and more likely every single meeting that goes by, they are going to overcook it, and they're going to use the same tools that they were using to essentially stimulate the economy, very similarly to how they were doing it in 2020 in the pandemic. Now, what is that? Well, it's cutting interest rates and buying bonds. Now, here's where the trade comes in. So if you made it this far in this video, congratulations. You're setting yourself up for some life-changing money here if we end up getting that signal, which we're going to talk about at the end of this video. So make sure you guys stick around. So I want to bring you guys back to exactly what happened with the 10-year Treasury yield back in 2020. Now, as we're starting to get into more fear in the pandemic here, you see bond yields aggressively drop, meaning people are going risk off in buying government bonds. Now, what ends up happening is these emergency rate cuts come in, people start buying these bonds back up, and more emergency rate cuts, and then these yields start to come right back down. Now, what did that do to an instrument that we are all able to trade through options? Well, we can first look at TLT here. This is going to be the inverse of the 20-year Treasury yield. So in this scenario, if Powell is going to be using those tools, those quantitative easing tools, such as rate cuts and bond purchases, this is something that can happen with TLT here. It can go from a level of 144 all the way up to around 179. Now, you may not think that that's very much, but the last time that this happened, these options went over 10,000%. That's why we've been talking about this so much, because every once in a while, you will see these very narrow opportunities happen in the market. And if you're able to identify the very, very specific conditions that need to be met, you can make a lot of money. Now, it's not just TLT here. We can look at TBT. Well, it looks very similar to the 10-year Treasury yield back in 2020, and TBT is actually not the inverse. So it's the inverse of TLT, which is the inverse, if that makes sense. Now, up until this point, we've talked about what's happened in the past, 2 years ago, back in 2020, and what happened with TLT and TBT. But I want to show you guys what happened recently, which is a prime example of what could easily happen with the Fed if they then decide that they have over-tightened. And we've been talking about these gilts a lot, these 30-year government bonds in the UK. Now, what happened? Well, you see this aggressive run up here. Their pension funds were having aggressive issues. And then the Bank of England stepped in and started buying these bonds. These yields went from 507 all the way down to these lows of 3.634. They aggressively bought these bonds, which aggressively pushed these yields down, which is exactly what could happen with the 10-year bonds and all of our government bonds as well if this quantitative easing ends up coming back, even if it's short term. But that is exactly what we would want to look for TLT and TBT. So here's what I'm looking at going forward and when I could potentially see this playing out. So the projections right now are that we're going to get to terminal pretty much by March or early late spring of next year. Whatever that terminal rate is, well, right now it's supposed to be between 4.5 and 5. But remember earlier in this video when we were reading through that transcript, well, that terminal rate is most likely going to be higher. So it could take a little bit longer for this to happen. Okay. So then we get into the summertime and we are really going to get another indication of, okay, how much have rates risen? And where do we see things going in the future? And have we actually met this soft landing? That's the key point here. But remember, as rates get higher, the soft landing actually becomes less probable and the possibilities are narrower, if that makes sense. So what I'm going to be looking for is a very specific statement from the Fed. It's going to be very blatant. You're going to see it. Everybody's going to be talking about it. You're going to see the market react, and it's going to be that massive pivot. Now, I've talked about this a lot, that there is no pivot right now. It makes no sense for the Fed to pivot. You're still seeing super high inflation. You're seeing the labor market extremely tight, and all of the other data points out there are pointing to the fact that a pivot doesn't make sense. But there is going to be one coming eventually, and the odds of Powell overcooking this market to the other side, very similarly to how they did it with quantitative easing last time, that puts us in this situation right now, are very likely. So when we see Powell come out and say, yep, we are going to be buying those government bonds. We are going to be doing these potentially emergency rate cuts. That's going to be the flashing green light to me to start going for TLT. Now, this is going to be the first video here where we talk about this, and I want to make sure that we have this video out in November of 2022 as a thesis for this trade going forward. But yesterday was the first day that we really got that green light from Powell that this trade that could potentially happen next year is looking pretty good. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. I'll see you in the next one. Peace.